one of the things that Anvil aims to do is to be that bridge to TradFi to say, hey, we can prove on-chain that this collateral is reserved for you and only for you.
Folks, this is Frederick with Bitcoin.com, and I've got a guest here. You could introduce yourself?
Yeah, absolutely.
Let the people know who you are.
All right. Hey, I'm Em. I am the project lead for the Anvil protocol, created by the Acronym Foundation, and it's a protocol for on-chain collateral management, which might sound a little dry, but some awesome stuff you can do when you actually dig into why digital assets make for amazing collateral on-chain.
Are you enjoying Consensus?
I love it. This is my first time here, and it's very funny because I'm a Texas guy, and it used to be in Austin, but I really like Toronto, and it's a lot of fun, and we've got a pretty cool booth that people are interacting with and everything like that. So no, it's a good time. I've got to see a lot of old friends in the space and make some good connections. Yeah, it's awesome.
So what's behind the strip mall concept? So the booth is a strip mall concept. What was the idea behind the thinking behind that, I guess?
Yeah, so the foundation itself, the Acronym Foundation, has a few different properties, and its latest is called the Digital Spenders Club. So it all kind of ties together where, like Anvil is collateralizing digital payments, is the system which you can collateralize digital payments, but it's awareness of being able to spend digitally anywhere, right? And so we've seen this rise of payment rails to be able to accept this at point of sale, big retailers and all that stuff. So we partnered with a company called Burner, where they have tap to pay hardware wallets. I don't know if you've seen like little cards, and it's just like, you tap them against a POS system and it pays. So we're giving out things that look like the old school Blockbuster membership cards. I don't remember those for the 90s. So they're like laminated and everything. Yeah,
I do.
90s nostalgia is
I'm
like
old enough to remember that.
90s nostalgia is really big. I met some younger guys and they were kind of like, this is cool, but we don't get it. And like, yeah, this used to be a thing, right? So we've been giving them out and loading them up with USD2 and USDC, and so they can go pay at point of sale. So we have like merch, and we have a nail salon, which I got dragged into doing, and a 24-hour photo booth. It's a bit of like 90s nostalgia to both kind of like speak to this generation of millennial crypto people, but also to show like, hey, this is what's possible. You know what I mean? If you spend using crypto and how easy it can be, and like way less expensive in terms of merchant fees and all of that stuff. We just need to get all the integrations up and running. So it's interesting because Anvil, the thing that I run, helps make a lot of that stuff possible. So to give you an example, I don't know if you're familiar with Flexa.
Flexa, no.
Yeah,
no.
So what Flexa does is they're like the world's largest purely digital payment network. So they basically work with payment rails and like major retailers to allow you to pay with crypto at point of sale. So like you can pay at Chipotle right now with crypto, right? And the way that they can guarantee that is that they have all this collateral and reserves in what they call their flex capacity system. And they're actually using Anvil collateral pools to backstop all the payments, right? Because if you pay with Bitcoin, you can't be waiting around like 13 minutes for a block to get mined for you to get your beer, right?
Right.
So Flexa, what they'll do is they'll guarantee it to the merchant and pay them in fiat currency that they want. And meanwhile, they're handling all the settling, and the way that that's all able to settle is with efficient on-chain collateral. So Anvil actually is the protocol that helps make all their backstop reserve happen.
So you've got the Acronym Foundation.
Yeah.
And then you've got Anvil. Is that a separate project? Is that a...
Yeah, Anvil is kind of like its own self-contained project. It's, we created this protocol called the Anvil protocol. It's decentralized. We have a governance token. And so we've been working a lot on that. So I think it all stemmed from, Tyler, our president, kind of had this vision that like collateral is not being done efficiently. Okay. And I think because he's been in the digital payment space for so long, he realized this need to not just have, we got started with the AMP token, which is actually that token that helps Flexa. That's the collateral that they use to stake to backstop all Flex's payments. But there was this need for like a purely flexible, brand new protocol that handles this specific problem of on-chain collateral. Because we see collateral all over the place in Web3.
Right.
But it's always like an extension of some other product, right? Oh, it's a lending protocol, but then you have to collateralize it with something, right? But I don't think anyone's thinking about this problem specifically and just saying like, okay, how should collateral, like what is the most effective way to use collateral on chain, right? And then we become part of the stack that everyone can leverage this open source, it's free to use, right? to use collateral effectively. So this is like a contained project within the Acronym Foundation. And actually, I just spoke at Futurist, and one of the things we're talking about doing is, we've created a new company called Anvil Research Labs, where it's like fully going to be devoted to this protocol. So yeah, Anvil, a lot of exciting things are happening. I mean, we only launched officially a little over 3 months ago, and we already have 85 million in collateral in the vault. And by TVL, we're already like a top 100 Ethereum protocol. So a lot of traction, but we got a lot of big ideas in terms of like what the next way we're gonna allow users to leverage their collateral, right? So it's like a single place where it's like, okay, you have all your long-term holdings, right? You have, your wrapped Bitcoin, Ether, all this stuff, right? And you're like, you're gonna hold on to it anyway. But how do you put it to work for you? Because one of the big problems is that all these people that, the people that we love that have adopted crypto, like traditional finance companies are looking at them sideways like, we're not going to give you a mortgage based off of that. We're not going to give you a credit card. You might not have any credit history, bad credit history, right? And so one of the things that Anvil aims to do is to be that bridge to TradFi to say, hey, we can prove on-chain that this collateral is reserved for you and only for you. And then you'd say, oh, okay, I'll lend to you because I know that if I need to, I can go claim that wrapped Bitcoin, right? Or you can use collateral in something like wrapped Bitcoin to make a promise to you in USDC. And I'm like, imagine I'm a lender, right? I'm like, I care about USDC. It's the only thing I care about. To me, that's as good as money. I might have an institutional account or something like that where just take USDC and, turn it into fiat in my bank account. So operationally it works, but like, you've got Bitcoin. And so what it allows you to do is over collaterals with wrapped Bitcoin and make you a promise in USDC that's always good. And even if the price of wrapped Bitcoin were to plummet, you know what I mean? It'll liquidate similarly like Compound does to get the USDC to fulfill that promise. So all you need to know is that you made me a promise for 100,000 USDC and no matter what, you're good for it. So now I can give you a loan. Now I can give you a line of credit at whatever you're doing. If you're, a retailer or, maybe a casino or you're an auction house or you're just, giving someone a car loan or something like that. So it's like, we're trying to find the ways to say, like, you don't need to understand how it works under the hood if you don't want to, just that there's a guaranteed promise backed by digital assets. Because you can't this is something I mentioned on Tuesday. There's no way for me to be like, I'm going to give you a line of credit, right? But that $50,000 in your bank account, that I want you to hold on, that's reserved. Don't move it and don't promise it to anyone else. You can't do that, right? You can't tell me this is my money. There's no good way to do that, right? So we can move it to an escrow service or something like that, right?
Right.
But it's like, there's no decentralized way where you actually still get to hang on to that, right? You don't have a taxable event or moving any of these assets. But like digital assets, you can do that. And so we built the protocol saying, no, that is reserved for you. Even I can't take it away. That's how good of a guarantee it is to you. And then maybe at the end you wind up claiming my collateral, or maybe even better, you actually, we settle up either off-chain or separately and you release it. So like, I'll give you an example. That booth that you saw was super expensive, right? But like we had to book that a year in advance and it cost a lot of money. And one of the things that I like to think about is like, did we actually have to give 6 figures worth of value a year in advance in order to secure the booth, right? Well, the organizers of this awesome conference are like, well, we got to know that you're good for it, right? We got to know that you're not going to back out because we have a limited time to sell these booths. It's really competitive, right?
Right.
So really what you don't need right now is the money. You just need a promise. So if I could issue you a promise for 100K in USDC and then pay for it at the very end, that whole time you're like, if they back out, I can get that money. That's a guarantee that they have, so it solves the problem. And here's where it gets awesome. This is the part that just gets me so riled up, right? If you use a yield-bearing asset, like, I don't know, like SUSDE or something that naturally earns yield over time, right? It's like native to the currency. We could have made yield over that whole promise. So it's like, we could do this 100,000 USDC promise for a year. And by the end of it, that collateral might be worth 115,000. And at the end, I give you your 100,000. You say, great, you release the collateral back to me. And I just made $15,000 because that was still my money the whole time, right? I get that collateral back. That doesn't exist in traditional finance. And this is why it's so cool that like protocols like this actually separate this idea of like, when do you have to pay? And when do you just need to say, I'm good for it? I can prove to you that I'm good for it. And that I prove to you that I'm good for it says like, you can earn money. We part ways with our assets so early because that's just typically in traditional finance how you have to do it. But now it's like, no, you could be earning this whole time while you have promises out all over the place. And so the goal is like one ecosystem where you're like, okay, I'm going to store all my long-term holdings here, right? Because I think that all this stuff is going to go up over time. But while I'm holding on to it, I can pledge some of this here to be able to get access to a credit card, and some of this over here to get my mortgage. And I can borrow against some of it over here, and I can like stake in like what I was saying, Flex's like we use collateral pools. They use our collateral pools where they actually they give yields to people that participate and stake into it. So it's like now I have all my money working for me. It's still mine, and I can still always get it back at the end as long as I fulfill my financial obligations. That was a lot to jump on you. I'm sorry.
Yeah, no, it's a lot to dissect. Okay, so you've got this foundation, the acronym foundation.
Yeah.
And one of the projects is Anvil, and that's what you're working on, which is basically on-chain collateral management.
Yep.
Now, sounds very similar to something like staking, where you can like liquid staking, where you can, you stake an asset, and then you get this token that shows that you staked, and then you can do all kinds of DeFi stuff elsewhere. So it sounds very similar to that. Am I on the right track?
It's similar in that you can take advantage of your holdings while you're right, exactly. And we're talking about a central protocol where it's still yours. It's still attached to your account address in the protocol. There's just a hold on it, right? So think about a credit card hold, right? Like you check into a hotel and they, put a hold for incidentals, right? But that only lasts a couple of days, right? But what if I could put a credit card hold on my long-term digital assets? They're still mine, just to prove to you that I'm going to meet this financial obligation. If we're doing business, so we call the other mechanism of the collateral pools that we currently have, we call digital letters of credit. We call them locks. And like traditional letters of credit are needed because if you have like a factory in China you want to do business with, right? How do I promise them if you produce 100,000 units of this thing, I'm going to pay you, right? And they're like, well, we need to guarantee this. And I'm like, well, I'll pay you when you make the thing. And now they're at a standoff, right? So what happens is I have to go to my bank, and my bank has to issue a promise to their bank, and it takes time, days, weeks, right? They have to come up with a contract, middlemen, fees, all this stuff to just have disconnected financial systems say, hey, we'll vouch for this guy, right? And like say that he'll pay it. And you have this whole contract, all these middlemen, just to say, I'm good for this thing. If you give me this, I will pay you that, right? Now, with digital letters of credit, I can make you a promise right now at 3 o'clock in the morning and be like, great, we can get to work because that's good. And you don't have any middlemen and no fees, and it's free to issue. And it's like, that's how I really think this helps like transform, like when you start to really think about how many middlemen are involved in traditional finance and how often banks have to step in all this stuff. You can do this permissionlessly with the decentralized protocol. You just need like that to have been the purpose. And that's why we've spent a lot of time thinking about what efficient on-chain collateral looks like.
Okay. So how do you, so first, what platform is this on? Like what blockchain are you guys using? Ethereum? Okay.
Mainnet, yeah.
So if you're on Ethereum, do you have some kind of like multi-sig? Is there some kind of multi-sig functionality that allows multiple people to have to sign on a transaction before it's released, or like how do you do it?
Right. So what we do is we have this vault, and that's like central to the whole thing. So you deposit your assets in the vault, and it's you have an account that's assigned to you, right? So here's all of my collateral, but it's not in my wallet, it's in my vault account, right? So it's like I think about this as a savings account, right? So if your wallet's your checking account, this is your savings account. Here's all my assets, right? And then from there, I can use them in locks, digital letters of credit, or put them in collateral pools or any of the other mechanisms that we're building, and it'll put a provable reserve. So you interact with our letter of credit contract and you say, hey, I'm going to issue this digital letter of credit for you for this. It's going to expire on this day. It's worth this much, whatever. And then actually, I can't take that back. The only thing is the creator of that lock I can do is I can extend it. I say, hey, I'm going to give you credit for more time, or I can change the collateral amount. So in that example where I'm using Rat Bitcoin to promise you USDC, if Rat Bitcoin starts to drop and I'm at risk of liquidation, I can add more to the position to make sure it doesn't get liquidated, right? Or conversely, Rat Bitcoin goes to the roof, I can actually take some out and be like, I'm way over collateralized. I don't need to have all of this reserving, right? So that's all I can do from the creator side. You have to let me out of it, right? So it's a promise to you. So that's how I can't rug you. I can't be like, oh, I'm going to take my collateral and leave now. You're like, wait a minute, we might have business going on. You might be building me a house, and this was a promise to do it, right? So it puts all of the power in your hands to say, this is how I'm going to prove to you that I'm good for it. And then it's up to you as to when and how to let me out of that collateral. If you're going to claim it, if I walk away, or if you're like, oh, let's just settle up by claiming it. Or, if I actually wind up paying you at the end of, the house gets built, I pay you, and you're like, great, I'm going to cancel this and release your collateral back to you. But it stays associated with my account the whole time. So the vault acts as like, it has everybody's addresses and everybody's assets in there, and then an accounting of which assets are reserved and for what.
And it's probably there's some kind of time lock on it, where for the length of the credit period. The one person can't take it out, and no one can take it out until a certain time, and then there must be some way to decipher who has the authorization to get the money, right, to get paid. Like have they fulfilled the promise, and now they can get their money back, or they have to pay they have to pay the money now that was being held. So that's all in the smart contract.
That's all built in, right? So you can fully
and is that an open source project?
Totally open source, yeah, absolutely. Anyone can contribute to it. We have a very robust governance that you can submit a proposal if you want to upgrade a contract or add support for more tokens or anything like that. So yeah, we're very much community led too. We're just continuing to maintain and upgrade and expand on the protocol because we're the ones that created it. But really, these tokens are out there. We've distributed. We actually gave away 60% of all the tokens that are in a vesting contract. So yeah, but even though they're in a vesting contract that people will get over the next 4 years, they can still use that to vote in governance. We want people participating in our governance and helping us, keep everything in check and figure out what the future of this protocol is going to look like. But yeah, so to your point, you could redeem that letter of credit fully or partially. And I'll give you, so that example where it's like, hey, we made a promise to Consensus that we're going to pay for this booth in a year. They might say, oh, okay, well, there's a 15% cancellation fee after this date, right? So what they actually could do is if we walk away, after that date, they could literally just say redeem for 15,000 USDC and then cancel and then release it from us. And that ensured, right? So it's so all those permissions are built into it, and it was done intentionally to make sure that our saying is that a lock is always good for the credited amount. So no matter what happens, you actually don't need to care how I collateralize it, just that if you trust the system and it's open source, and we've been audited twice by Open Zeppelin, once by Trail of Bits. We have an ongoing Immunify bug bounty going on. We pay a lot of money if you find a critical bug, all that stuff. So it's been battle tested. We have $85 million in collateral in there, so come get it. But this is, if you trust the system, you're like, great, I just know that I'm promised 100,000 USDC. I don't care how the rest of it works. And if I need to get it, I can get it up until this date, right? So it's a very simple thing to make a guarantee like that. So I don't think that this is totally revolutionary and really convoluted. It's just a simple guarantee. But when you start to apply it to how this can transform business and industries, there's so many different ways in which these little promises help solve for so much inefficiency that currently exists in the market.
Yeah, so it looks like you would have, so I'm not sure what the product actually looks like in real life, but I would assume that if a retail user is using this product, maybe they have all of these parameters and they can say, so let's say the two of us are agreeing to some kind of loan, or you're trying to rent some property or your booth there. So those terms, 15% cancellation fee, the date when you're supposed to pay, how much the deposit is, would that be a dashboard where you kind of decide and agree on terms? And then
you should settle the terms in the way you normally handle business outside of it, but the parameters of the lock should match the terms. So you're like, okay, we're agreeing on how good it is for it. But if I'm the one pledging the credited amount, to you in collateral, then I'm saying this is good for a year, and assume that lines up with, we already discussed it would be good for a year, right? So it's important for the guy on what we call the beneficiary side, the guy receiving the letter of credit, to go yeah, okay, this is good for me, right? Otherwise you just be no, this is unacceptable, you cancel it. But it's
But I
funny
mean,
that
but I guess my question would be, so you talked about an agreement. You know, when you have a loan, you have an agreement,
Yeah.
right? Let's say I'm not a crypto native, or I'm not that technical, right? But I want that agreement to match the smart contract. So I want the two to be, I want the real life contract to match the smart contract, so that the terms, so that the smart contract behaves in the way that the legal contract is drafted.
Okay.
Right? Like if it's a 15%, the
yeah.
length and the amount and everything. So how does that happen? Or
So
is
this,
it?
so this is just like the collateral mechanism. It's not meant to like take in all these different kinds of parameters.
Got it. Okay.
Because they're building blocks, and you could totally build. So this is the best part, right? Both sides of this doesn't have to be you and me. It could be another smart contract that actually wraps all these details into. These are just individual building blocks to do this. But to answer your question, how you do it, it's really funny. So we've got a whole bunch of volunteers that are working in our booth. We have a very excited and engaged community. And they all flew out here to like help us run, our giant booth and everything. And one of the guys, we're at dinner on Tuesday night, and he's like, "Oh, I started personally giving loans to other members of the community based off of blocks." And so the way you do it, if you're not, super crypto native and you don't know how to interact with the smart contracts directly, we have a DApp on app.anvil.xyz. You go in there, you just go create, you connect your wallet, deposit assets into our vault, and then you click create lock. And you can set, okay, here's the day it's going to expire, the time it's going to expire, how much it's for, how much I want to collateralize it with. You can see the liquidation risk right out of the gate, so you can make a good judgment as to how much collateral you want to pledge for it, right? And then the address of the person you're sending to. And then you go on the DApp and you say, hey, I got this promise and it's for this amount and it's good for this day. And then there's the buttons as to what you want to do with it. So we have a DApp that gives you all that flexibility, but then we're also building an SDK. So it's really easy for other companies to like drag and drop these components into their applications. Like, hey, I want to be able to like have our users issue us a lock. Great. Drops it in, and it's super customizable that like, you could add your own branding to it, and you can set the parameters how you want. Like there's certain things that are already known, like, okay, well, you're issuing the lock to us, so you don't need to worry about filling the to address out to the beneficiary address. We got that covered. And we know what day and what time for the duration of the loan. So that's how we're starting to get to that place of like, okay, if I'm going to issue a loan, how do I make sure it's like, well, if I'm the person accepting the lock to give you a loan, I'm the financial company. Well, I can pre-fill a lot of those parameters for you in the user experience. So you just need to choose things. And I know I've chosen parameters that comport with how we're going to give you this loan and everything like that. So the SDK allows for that level of flexibility. Our DApp is very like everything is exposed to you, but it really like lets you use it on an individual basis and explore the functionality.
So it's like if you're building your own app, you can integrate Anvil into it so that you have the collateral management part handled through your SDK or an API or something like that.
And the cool thing is like you don't even need to, if you're like just like a normal traditional company and you don't know how like to handle a lot of this Web3 stuff, you actually don't. Like our SDK will have all the like Web3 connection stuff into it with wallet, all the like connecting your wallet and all that stuff. That's all built into it. So you actually don't need any, Web3 related tech in your app if you don't want to. The Anvil components will do it for you.
So this is live, ready. It's open source. And it sounds great. How are people using? You have 85 million worth of collateral on chain right now. How are people using that? Like what are people using that collateral management system for right now?
Great question.
Like, what are some use cases?
Right. So Flex is a big one. I told you like all of their payments that they do are collateralized using Anvil collateral pools. So they have, I think, 20 pools set up, one for each of their different kind of like payment systems. Their payment pools, like different, if you're paying with Bitcoin, it's one pool. And if, the Nighthawk wallet's another pool, and Base. I don't know a ton about their like the intricacies of their business, but they have different pools set up to backstop different networks and products that they're using. So they're using that to collateralize all their pools. And then on the other side, we have companies that are doing loans against your crypto holdings. That's one use case of how this could work. And then we're also working with a couple other integrators to set things up, like around the line of credit type thing, right? So, I mean, here's an example that, I don't think a lot of people think about, but it's really funny that like, if you, I don't know if you're like a gambler, do you go to like casinos ever? And
no, but meme coins.
yeah, right. Everybody, well, that's the thing is, right? Like crypto
That's
people and
gambling.
gamblers, they're all kind of to right. But like if you think about the experience of going to a casino, so casinos will give markers or like let people gamble on credit if you're a high roller, and they're like, yeah, no, go ahead, right? But that could actually be available to everybody if they had a lock as a guarantee, right? Because think about the absurdity of this. Like, okay, let's say I have all my money in crypto, right? And now I want to go gamble at whatever casino Toronto has. I think you guys do have like a bunch of casinos. Yeah. So I want to go gamble at the, okay, so what do? Well, okay, I got to sell enough of my assets to get fiat and then get that into my bank account and then take out money from my bank account through the ATM to get cash, to go up to the cage and give them cash. And they give me chips that represent that cash. And then I go gamble. And then based on whether I win or lose, I bring those chips back. And then I get them. I mean, do you see how many steps there are, right? Now imagine this. Walk right up to the cage and they say, hey, scan this QR code and then issue us a lock. And you're like, okay, I'm going to issue a lock for 100,000 USDC. And you're like, great, here's 100,000 chips. Give it back, don't give it back. We don't care because we'll just turn around and claim it. We always know that money's good. But now I get the flex. I didn't sell out any of my digital assets. I didn't have to have a taxable event, any of that stuff. And now I go and I gamble. And let's say I make it $20,000. Okay, great. I come back to the cage and say, here's $120,000 worth of chips. They go, okay, here's $20,000. We canceled the lock for the $100,000. And it's like, I never sold out of my position. I was able to gamble flexibly up to $100,000. I made money, like all without having to go through all those other steps we just talked about. Because when you go into a casino, you actually don't know, am I going to owe you money? Are they going to owe me money? Any of that stuff,
it
right?
It just depends on what happens. Yeah.
But this is a guarantee that is like...
Usually you owe them money.
Right, usually they owe you them money. But they can settle up however they want, right? So you can actually go to them and say, okay, I lost $15,000. And they'll say, do you want us to claim $15,000 in collateral? Or do you want to give us a check for $15,000 or whatever? Here's $15,000 in cash. Great, we'll cancel the entire lock. I get all my digital assets back. But the point is, like, the digital assets I had, that flexibility, what Anvil I call the savings account aspect that actually works for you, right? Gave me the flexibility for the casino to be like, oh, we don't actually need your money right now. We just know that we can get it in the future. And it gives me way more flexibility, right? So think about all the places where you need a line of credit to prove that you're good for something in order to just do stuff. And the end amount might not even be known yet, right? You don't know, are you going to owe me money? Am I going to owe you money, right? But the guarantee is in place to know that I can't screw you. I can't walk away. And the casino doesn't need to be worried about it because they'll be like, all right, this line of credit is good for 48 hours, right? If you don't show up in 48 hours, you're just going to claim your collateral. So turn the chips into cash or whatever, right? But it gives so much flexibility. And then you think about like, what's that like at the, now we have all these like, sports books, online sports books, right? DraftKings and all those guys, right? And it's like, that could be super simple too, where it's like, oh, you just like connect your MetaMask or whatever wallet of choice or whatever, issue them a lock right there and they're like, great, go ahead. Make up to this amount of bets that you've given us a line of credit, and then we'll settle up later. And these guys are always looking to get guys in the door, right? They're like, here's a free $100 if you bet on this NFL game, or here's whatever, right? Come do it. It's like, wait a minute. You don't even need to give us, you could just literally pledge digital assets, and we know that you're good for it. Come on board.
So that's like the key. That's like the key feature of that service. Basically, you don't have to liquidate your crypto. You don't have to move it. You don't have to do anything. It's just there, and and the person that is loaning you the money or the service has a lock on that money without it having to be moved or liquidated or the taxable event.
Right,
like
you can't do it in traditional business, right? I told you the closest is the credit card hold, but I can't be like, no, look, I have the money to pay you if I have to. And like, we don't trust you. We don't trust you to pay us, right? You can't prove that to me, but I can if it's digital assets. Like, look, it's in a smart contract and it's pledged to you, and I can't even take it away.
And you have the ability to liquidate that cash.
Yeah.
So how did you get into crypto? We'll just end with maybe your journey into into crypto.
Absolutely. So I have a super backwards journey. I feel like there were people that were true believers that came in and all that stuff. I came backwards. I was always a product guy. I led a lot of engineering teams and I did some engineering myself. I'm always thinking about like product and design and like, I always wanted the stuff that I worked on to be impactful. And then my first company I worked for was Consensus, not this kid, the SYS, the big one, Joe Lubin and all that. Joe Lubin, yeah. And so I worked there, not in the early days, but in the earlier days. And I got the gig because they needed a product guy, and I had worked with an engineer who referred me in, and I came and I took on some projects. And I approached it more as just like a consulting, like, oh, I'm just going to do this for this industry now. I don't know a ton about it. And in doing a bunch of those use cases, I started to realize like, oh my God, this tech is like, can modernize so many things. And it can bring so much transparency to industries that have so much inefficiency and middlemen and opaqueness and all this stuff. I got to work on some awesome stuff like music rights and all kinds of things, artists getting screwed, like promising, like blockchain, having a transparent, immutable technology is amazing for this stuff. So I was like, oh my God, this stuff's so cool. But at the time I was getting super frustrated.
What year was that?
So this was 2018 through 2022, I think.
So 2018 to 2022, that's okay.
Yeah. So I spent a bunch of time working on a bunch of different projects, and I loved the tech and what was possible, but I found it super frustrating that I feel like the user experience of the industry was not, we weren't in a place to like really get people that weren't already like crypto true believers. We were really good at building crypto products for crypto people, right? But that's not the goal. The goal is to modernize everybody, right? So it was still early days on some of that stuff. And so I left to go run product at a traditional, Web 2 big, enterprise SaaS company. And then I came back into the blockchain world to do this. And I was so pleasantly surprised at like all the changes that have been made and how much more mainstream the technology was. Because back at the time I was yelling about NFTs before anyone knew what NFTs were. And I was like being like, oh no, like there's implications here. Like you can have like provably authentic things. Like you're always worried like, oh, you go to auction. Is this real? Is this not real? It's like, oh, do you have an NFT digital twin that proves that it's real? And all that stuff. And I'm telling all these people, and people in the traditional business world are like, what? This is a fad. This isn't going to last. And then I came back and everyone's like, how do we integrate with blockchain? I'm like, I'm glad you guys are ready now because, I'm ready for it. And so I got brought back in by our CTO, who I had worked with back in the day, and he's like, meet Tyler, talk to him about this use case that we're trying to solve for Collateral, and my eyes like lit up once I really started digging into it because I'm like, oh wow, the implications of this are enormous. Like we're really going to change a lot of industries and for the better. And we're not like trying to make money, you know what I mean? It's like it's a free open source protocol, but like it solves for the inefficiency problem. And that's the stuff that I think drives me crazy is when you look at industries and you're like, oh, there's so much inefficiency here, right? You go to like, even just flying here, the airport, all that stuff. You've ever like been online somewhere, you're like, man, this could really run so much more efficiently. But like, oh, they just can't figure out how to modernize. So these industries that are so legacy, right? But in the early days, I felt like, or when I was working on stuff, I felt like the companies, and there were like traditional companies that really wanted to adopt blockchain technology. It felt like they wanted to do it because they wanted to be seen as super innovative and ahead of the curve, or to do like, just because it's like a cool marketing buzzword or whatever. Some of them had like some good use cases, but they were doing it because they liked the idea of being a little bit more cutting edge, but they didn't feel this necessity to do it, right? It was like, oh, look what we're doing, right? It's like right now with AI, it's like, oh, I got AI in my thing. You have AI in your thing, right? So everybody wanted to do blockchain back then, but there wasn't this thing, it's like we have to do it, right? But now I think these companies are realizing, all these companies that wouldn't give us the time of day, 6 years ago, 7 years ago, all of a sudden are like, oh no, this is where this is headed. And the cool thing is it's not just because it's a new, cool kind of technology. It's like a market imperative, right? If you believe in free markets and you say, hey, over time, the market will get more efficient, the money will find a way to get better and smarter and faster.
Right.
They're starting to realize like, oh, this is where it's headed. And so now people are starting to understand like, this wasn't just a fad or a new thing. This is like where we're headed. So we better get on board. And when you can bring something to them like digital letters of credit and say like, hey, everything you just did, you didn't need all these middlemen. You didn't need all these fees. You didn't need all this uncertainty where you have accounts receivable departments all stressed out about whether or not, they're going to get their money. It's like, no, we can solve this. And it gets way easier, right? So that's the kind of stuff that just gets me out of bed in the morning, gets me super pumped up. Just because there's this massive inefficiency. It's not something we think about every day. There are people, I talk to people about Anvil and about what's possible, and usually it starts out and they kind of like, oh, this seems kind of academic, or I don't understand how this impacts us. And then when they see like the actual use cases like that I was giving you, they're like, oh wow, I didn't even think about how inefficient it is for me to give up money before I have to. And you're like, yeah. Why do you think like, I use this example at ETH Denver. I was giving a talk and I was talking about when I first got my Amex. I got my first Amex card in 2014 or something like that. And I logged on and it said, please pay by. And I was like, what's a please pay by date? Is that the due date? And I looked in and it's not the due date. it was kind of like a UX lie. They were telling me 15 days earlier because they realized if everyone pays us 15 days earlier, we can make a ton of money off of having all this capital for 15 days, right? So it's like, oh, they're trying to pull a fast one on everyone, but like that's the power. If you're a financial company, the power of having everyone's money 15 days sooner is enormous. But normal people weren't able to like get access. I can't earn yield in 15 days. I can't get in and out of a T-bill in that time, right? But now with digital assets, we have so many things that just earn all the time, right? Now you can do that. So now the power of giving up that money 15 days, wait a minute, I could have gotten 15 days of yield in DeFi. That's why DeFi is awesome, right?
Right.
Anyone can make money off of this stuff. So it's like, now it's like, oh no, I'm not gonna give you money a year ahead of time. I can give you a promise, but that's my money to earn on, right?
Right. Good idea. Well, there you have it. Anvil, acronym Foundation. Frederick with Bitcoin.com. Thank you so much. Lots of energy,
Thanks.
and I can see that you're passionate about the project.
Yeah, I'm super pumped. But
Yeah.
go get your nails done at our strip mall.
I want to get my nails done, people.